You're listening to Money Never Sleeps Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Greed, for lack of a better word, is good.
You know what I mean?
Money to be made in a place like this.
Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine when it hurts.
You know what it takes to sell real estate?
It takes brass.
I've fallen, and I can't get up.
All right, welcome to Money Never Sleeps. This is a show where we talk about anything and everything that impacts the flow of money from around the corner to around the world, and I want to thank you for joining us today. As you may or may not be aware, Money Never Sleeps Radio is part of the UCW Radio Show series where we bring on guests and we speak to a lot of different people and have been doing that for the past, 20 years. And we use Money Never Sleeps to go and help the investment community we can. Give our insights, our opinions. And again, you take them as you wish. You take them, take it as a grain of salt. But we do try to give some information here that can, kind of make you think about certain things in the marketplace, and all markets, by the way. Today, I'm going to be talking about digital asset treasury companies. It's interesting. I think that, investors have a misconception of a digital asset treasury company. They need to understand that there's a difference between a pivot in distress and an actual DAT company. Purpose-built DATCOs, which is a digital asset treasury company, and that can be, something that originated as a SPAC, but they're formed specifically with a clear, concise mandate to accumulate, manage, and deploy digital assets as a core treasury strategy from inception, from day one. Okay, so they're meant to do that. That's their mission. They're focused on it. If you wanted a proxy for a digital asset, that's the way to go. That's, along the lines of an ETF, pretty much, but something that is scalable. Something that can continue to grow, because it's a DAT company that can raise more capital to acquire more digital assets, take them out of the circulating supply and monetize them and do a whole number of things. But it can add value as long as the crypto space is moving in the right direction and the token that they have in their treasury is moving in the right direction, then they'll be in good shape. They don't acquire the digital assets to sell them. They don't acquire them they'll leverage them and maybe borrow against it and do other things, but they're inherently not selling them. They're not selling them. That's not the purpose. That's not their mandate. Now, on the other end of the coin, you have the distress-driven pivots. And this happens when you have a company. Whatever company it is and is publicly traded, I've seen a lot of this with biotech. And it's funny, and I want to go into that in a bit. What they do, they adopt the digital asset treasury, and they adopt that narrative late in the game. And what they wind up doing, they do this when their core operations start to deteriorate, and they go along the digital asset treasury route, and they put out the press releases, all the announcements, they're doing all these things. You're a biotech company, you're consumer products, whatever you're doing, you're not in the DAT game, but you're doing it and you're trying to get the interest. That's a situation that doesn't always work, because you go from having a company that does a thing, now you're integrating something in there the wrong way, and you're trying to pivot your core business, and you're not pivoting. You're kind of shelving your core business and you're pivoting to that, thinking that you're going to compete against a native DAT company. You're not. That's their mandate. And some of these companies are coming into the game thinking that they can navigate the decentralized space, and that's an error in judgment, I got to say. Now, this is what a purpose-built DATCO looks like. Capital's raised explicitly for digital asset exposure and treasury strategy, for them to accumulate, put in the treasury and build up. Okay, they have governance, custody, they put together risk frameworks, and they're all designed before capital deployment. They put all this stuff in order. The management, they have expertise in this space, in the capital market space, the crypto infrastructure space, and risk management. That is important. The business model is aligned with their business. Treasury yield strategies, asset accumulation, structured exposure products. This is what they do. Investors know from the beginning what they're buying. It's not a mystery. It's not a pivot. It's like, oh my God, I bought a company that makes ice cream, but now they're making widgets. Where did that come from? I wanted the ice cream. When you start pivoting like that, it creates an issue. So the DAT companies are doing it the right way. Again, strategy and a few other, Bitmine. These are companies, if you're looking for a proxy as far as any crypto asset is concerned, that's the way to go. That's the way to go if they started that from inception. Strategy is an exception because they pretty much set the stage for how this works. So they're like the OG in the space, right? So now this is what a distress-driven DAT company pivot looks like. You have a company, they have their core business. And we'll go with the biotech or something like that. So it's underperforming and they're under stress. They don't have the capital to go and do the things they need to do. Okay, now the company, what do? They start issuing press releases revolved around blockchain, digital asset, treasury diversification, blah, blah, blah. Then they start shifting from their operational depth and infrastructure, okay, of what they originally did. And now they're shifting into the DAT company space or trying to integrate and then trying to be a blockchain company, right? And it lacks that operational depth and infrastructure. Okay, you're making medicine, or you're going and you're in the beverage industry, and you go and you pivot to doing something like this. If you don't have that depth, that expertise of people in place to do it, this is like, smoke and mirrors. So people should be very aware of that and be careful. Capital raises, they become tied to the narrative rather than the execution. They're raising capital with the thought process that they are now a digital asset treasury company. They're not making medicine that's going to save people's lives. They're not going and creating whatever beverage they're creating or whatever widgets they're creating. They're doing something else because their business is failing. Now, if your business is failing and you did everything you could to make it work and you're making these pivot, okay, you're making a pivot. But, you got to put the right people in place to make it work, because otherwise it's nonsense. And a lot of companies I see doing this, and this is where you're going to have the big fail. And there are a lot of other things that go on there when they're making these deals to go and acquire these digital assets. They're making deals, they're getting involved in toxic debt, they're doing all this stuff. And what's going to wind up happening is that you're going to have shareholders, they're going to pay the price when things do hit the wall. And I don't say, if they hit the wall, I said when they do hit the wall. Okay, you don't pivot into a space that you're not natively in. If that wasn't your main purpose. It's okay to have a digital asset treasury. It's okay to go monetize that, for that to be a part of your company. It is not okay for that to replace your core business if investors got involved in your company for the purpose that you set out. That is a reality. So don't think that you can go and try to develop a cure, then you're going to be a blockchain guy. That it doesn't work that way. And when people do that, it's like the clown show. All right, you have to, you can't go and pull this stuff with investors or shareholders. It's not right. But anyway, so this is why we're seeing this in biotech. Okay, and why are we seeing this in biotech specifically? Well, it's not so much specific. There are other industries that you're seeing this in, but I see this a lot with some biotech companies. Look, they have long development cycles. They have binary outcomes. Either FDA is going to approve it or not. That's it. There's no in between. It's not there's no curves or anything. It's binary. Period. The end. a high cash burn. You burn through a lot of money before you get to where you need to get to. Okay, and the thing is, when the pipelines stall, the companies face dilution pressure, investor fatigue, and limited access to capital markets, all right, traditional capital markets, and they have to get into toxic debt and everything. So when they pivot to digital asset treasuries, I get it, and it's okay to do that, as long as that is not replacing your core business, right? As long as it's giving you life and not replacing your core business. You can have that, but not as a replacement, okay? And when they do this, what are they doing? They have a new narrative to re-engage markets. Potential access to retail and speculative capital flows, because now you're introducing a new methodology into what you're doing. Some may see it as a perceived shortcut to valuation support, okay, which, it is. But when you have the right players and the right partners involved, the reality is it can be a big win. It can be a big win. Again, I see this in biotech and some beverage companies and some other type of companies. It's not just with the Nasdaq. You see it on the OTC markets. You see it on the New York. You see it out there. And again, is there anything wrong with having a digital asset treasury? No, there's everything right with having one. Is there something wrong with taking your company where shareholders are in there and going and pivoting to a digital asset treasury company, and then going and raising toxic capital for this and pretty much diluting the hell out of your shareholders? Is there something wrong with that? Oh, there's no question, because then at that point, they're playing for themselves. They're not playing for the people that invest in their company. Now, another thing that transpires, it's beyond the digital asset treasury. All right, you have reverse stock splits. See this a lot, okay? And when this happens, if you have a digital asset treasury and you're doing a reverse stock split and you have a whole strategy behind it, it can work. When you go and you have a reverse stock split and you don't have a business model change, oh wow, okay, it's a problem. And why do lower tier Nasdaq companies repeatedly execute reverse stock splits? You see it. You can go and look at some companies, and they've done one this year, a year and a half ago, 2 years before then, okay, just to stay in compliance. And they do this because they want to maintain compliance with listing requirements set by the NASDAQ. Okay, particularly minimum bid price thresholds, but things are changing because now you need a minimum valuation, your market value, pricing, and other parameters are being set in place. That's going to make it so that the companies that are on the NASDAQ, that they're viable and they're growth oriented. It's going to get rid of a lot of the nonsense. And the companies that can't comply, well, they get downlisted. That's the way it works. Reverse splits, they artificially increase the share price, and it doesn't improve the revenue margins or the positioning of the company at all. Okay, again, more smoke and mirrors. Okay, when it's not paired with operational change, it becomes a temporary compliance mechanism. But the NASDAQ is changing that, so you can't play that game. And then what used to happen, and I doubt it's going to continue to happen with some of these companies, is followed by the further deterioration, and they repeat the cycle over and over again, and the shareholders, well, they're the ones that get hurt. Okay, and that's the retail investors. That's the reality. Because what do? They experience value erosion through dilution and reverse splits. You keep reversing it, you're diluting them, you're reducing what they have. Then you take a stock that's at a dime, you do reverse split on it, then all of a sudden your stock's at $3. Then all of a sudden, market makers, they see what you did, they're not stupid. Now they're going and knocking you down. Now your stock's at $1. Okay, so that person that had that stock that was at a dime, now what is it at? 3 cents for them? And then you issue more stock and raise more capital and you further dilute them? It's not good. Okay, and what happens, the retail investors, they'll buy into the new narrative, especially if they're promoting blockchain, AI. We're doing AI, we're in blockchain, this is what we're doing. We're the best in the business. They're doing it without fundamentals, without anything real going on there. It's a fluff and stuff, and at the end of the day, they wind up again, taking shareholders in that really shouldn't be in, not for those reasons anyway. Okay, and look, long-term shareholders that believed in the company in the beginning, they get diluted until they can't get diluted anymore. At some point they're gonna owe the company money. They keep going at that route. All right, and now the market integrity suffers. Okay, because as capital is misallocated to these narrative-driven pivots instead of viable business models. It is a delay in the inevitable. All right, you don't fix the problem. If you don't fix the pipe that's leaking, just put duct tape on it. Okay, at some point that's going to give, and you keep doing that. That pipe's going to burst. That pipe burst, and then that's pretty much it. Okay, now going back to what I said earlier, and the big question, I'll go to this, is can a digital asset treasury actually help a company? Can it help a struggling company? The answer across the board is yes, but only under certain conditions. Okay, and this is what doing it right kind of looks like. All right, a digital asset treasury needs to complement your business, not replace your core business. Okay, it needs to be an adjunct strategy, not a last resort pivot. Like, oh my God, I'm going to go out of business. I need to do this, or I'm done. Okay, when you're integrating institutional grade infrastructure, qualified custody, transparent reporting, defined allocation. This is the stuff that goes on with Hootex, and this is stuff that goes on Pico Nova's blockchain. You're talking about transparency, high fidelity transparency, and that's the great thing about that. You do that, you're giving the public institutions exactly what they need. Okay, and that clear capital allocation framework. How much is going to corporations, digital assets, and risk reserves. If you make the right partnership, you can get a partner that'll go in and work with you on that digital asset treasury, so that you don't have to go into your coffers immediately, but you work out a deal with them. All right, companies, what I've experienced and what I see is that they want someone to go and basically fund their digital asset treasury, so they can take those digital assets and sell them to go fund their business. That's not how it works. And when I'm told that, I laugh, because it's the joke of all jokes. You want money for nothing and your chicks for free. Okay, it doesn't work that way. It's supposed to benefit the company, not to go and liquidate, to go and do what? You need to be able to create value with your company. Risk management and hedging. You have to have volatility controls, liquidity planning. Later if you need it. Okay, I'm talking as far as when you're monetizing, and you have that. Okay, transparent communication. Okay, companies, they need to, not put out vague press releases, and I see that a lot too. You have companies that are putting out vague press releases about what they're doing, and it's again smoke and mirrors. You have to be honest. You have to just put the information out as it is. Okay, if you disclose on your holding, your strategy, your performance impact, and the groups that are coming in to help you, and not coming to go and screw you up, because you'll have a group that'll go and do that, and then take a whole bunch of equity and then go throw it in your face and do all this other stuff, and they and it causes a problem for the company. It really causes a problem for the company, and although you have groups that try to do things the right way, you have the companies that don't go down that road because they think that the grass is greener on the other side, but until they realize, oh my God, it's not, and now I'm involved in a situation where now I have toxic debt that I have to go and deal with, and now I have to go buy these digital assets that I don't have yet, but that's the deal that I made. So now where's my company going? Well, your company's going to go somewhere in a handbasket. I tell you that much. Okay, but look, when you have purpose-built DAT companies and they're out there, remember, that's a strategy-first situation. Infrastructure-backed, investor-aligned. They have their stuff in order. They have the people. They have the strategy. They have all this stuff together. They're ready to roll. They understand what they're getting involved with, and they're ready to roll. All right, if you see someone that's not in this space, that doesn't have this background, that doesn't talk about this stuff, that can't tell you about this protocol, that protocol, they can't tell you about the basics of blockchain and how things work and how these treasuries work and all this, that, and the other thing, and they say, well, I'm just gonna get a digital asset treasury and I'm gonna have this, and my public company's gonna have this. They're doing that. Yeah, be careful, because and that's not a DAT company. This is why I say, if you have players in these DAT companies that know what they're doing, that have a strategy in place, those are your winners. Because they act like ETFs. But in the digital asset realm specifically, of course, you have BlackRock and other companies that have crypto ETFs. But I think that a DAT company is a better play because they're going to do a little more, a little extra. That's their expertise. And they're going to, that return over time will, in my opinion, will increase. Now, if you have companies, when you have the distressed pivot companies, look, what do? They have narrative first. They're talking a big game. We call them the bean shooters of the world. They're talking a big game. They're going and painting this picture. They're trying to paint you a Picasso. Okay, they're trying to go Rembrandt. They're trying to paint this to get you involved, and they're reactive. They're not proactive. Purpose-built DAT companies, proactive across the board. They have execution depth like nobody's business. Okay, distressed pivots, they don't. They lack it. And what do? They try to go hire a company to go handle their treasury. They hire a treasury company to go handle it. Okay, and now you want to be a DAT company, and you have somebody else handling your stuff. It's not done inside. That's like being a it's like being a brokerage firm. You're going and getting investors. They're investing in your brokerage firm, but meanwhile you have a money manager managing your company's assets. I don't know. Doesn't make too much sense to me. Anyway, look, at the end of the day, just to close out the show, digital asset treasuries, they can be a legitimate strategic tool. I'm going to repeat it, legitimate strategic tool when used properly. Okay, but when they use it as a last-minute rebrand to mask operational weakness, oh man, what they're doing is just delaying the inevitable. They're transferring all that risk to the shareholders, and especially if they do a reverse stock split and they do all that other stuff. You got to look out for that. Look at the press releases, look at the SEC filings, check it out, and the difference isn't about the technology at all. DAT companies, digital asset treasury companies, they have an intent, execution, and discipline in the space. Companies that are trying I'm not talking about adopting a digital asset treasury to run in parallel with your company, but when they go and they adopt and they try to become a DAT company, you have to look at the intent. The execution is not there. The discipline definitely not there. And you see something like that, I would just say run for the hills. Okay, stick to the digital asset treasury companies that are genuine in what they are. And if the company's out there and they have a digital asset treasury and that's complementing their business, then that's a win too, because now they're creating two pathways where they have a digital asset treasury that they can go and potentially issue another asset class to raise capital and do other things. Okay, and help the company make an acquisition. It does increase the value of the company. But again, it has to be done the right way. And when companies do this and they take on toxic debt, that's what you have to look out for. When you look at the SEC filings, you see rights and warrants and all this stuff in there. Okay, I'm sure that no one wants me to say this, but I'm saying it because something? Investors need to know, shareholders need to know. If you don't know about this stuff, you should. So we're saying it on Money Never Sleeps, and this is what we're doing. Anyway, I hope that this was an informative show on digital asset treasuries and the difference between a purpose-built DATCO and a company that's making a distressed pivot, and the companies that actually genuinely adopt a digital asset treasury for the right reasons. You have 3 areas there. And when you're getting involved and that comes up, just take a look at it and be informed. All right, anyway, I want to thank you guys for tuning in, and we will be back with you with another episode of Money Never Sleeps Radio. And as I said, we're going to be looking to bring on some guests only to spice it up a little bit. I think next episode we'll bring back Money Man and we'll talk about some other stuff. But we will bring on some guests because we need to get some insight from other ends of finance that'll be a benefit to our listeners. Okay, thank you so much, and you guys have a fantastic trading day.
Initiating shutdown sequence.
You're listening to UCW Radio. In your face.
What is your major malfunction?
So let it be written. So let it be done.
Ladies and gentlemen, my mother thanks you, my father thanks you, my sister thanks you, and I thank you.
The views and opinions expressed on Money Never Sleeps Radio are for informational purposes only and should not be construed as financial advice. The host Louis Velazquez and guests of Money Never Sleeps Radio are not licensed financial advisors, and any investment decisions made based on information presented in this podcast are at the listener's own risk. Listeners are encouraged to consult with a qualified financial advisor or investment professional before making any investment decisions. The podcast hosts and guests do not endorse or recommend any specific investment strategies or products. All investments involve risk, and past performance is not indicative of future results.